necessarily think that the labor market is about to rip from here, but I think what's increasingly clear is that we're not flashing red like many at the Fed thought late last year. As the employment numbers came down, many were worrying that, oh my gosh, we were seeing a few 100,000 jobs a month a couple of years ago. Now we're just seeing 10 to 20,000 jobs a month now. But our view is that it's not a big deal. And the reason why we say it's not a big deal is that most of this is just due to a drop of labor supply.
But, I mean, Paul wants to jump in here, but let me give some history, folks. We are addicted to 200,000 non-farm payrolls. And I get it. Immigration's down, da-da-da-da-da-da-da. Are you telling me economically or politically a $50,000 non-farm payrolls is acceptable?
That's what I'm telling you. And the reason why I'm telling you this is because we're at full employment. Everyone has a job. And if everyone has a job and you're making decent wages, people are going to feel pretty okay about that.
Can this economy grow with no labor force growth?
That's the key question. And the answer to that is that we need productivity. We've seen a lot of productivity in the United States over the last couple of years, and that productivity needs to sustain itself. There's a lot of optimism over AI and what it could bring. We ourselves at BNP Paribas are optimistic about AI over the medium term. And as long as we continue to see relatively slow labor force growth, we're going to need that productivity to stay at high levels for the United States to continue to grow at the pace that we're used to it growing.
Do you think the Federal Reserve shares your optimism about productivity?
It's undoubtable that they do. In their last SEP, they penciled in higher growth numbers into the SEP.
Yep.
And that was largely on the back of, as Chair Powell said himself, the Fed penciling in higher productivity after having seen it now for multiple years in a row.
And looking at the world interest rate probability function on the Bloomberg terminal, the WIRP, kind of forecasting nothing from the Fed this year. Is that consistent with what you guys are looking for? No hikes, no cuts, just kind of sitting on the hands?
That is extremely consistent. We were very out of consensus earlier this year, where we were one of the few banks that were calling for the Fed to do nothing this year. And we think the Fed's going to take it a step further in reinforcing that message, where later this month when they meet, we think they're going to tell the markets that exactly the next move could be a cut or it could be a hike, and they're probably just going to sit on their hands for a long time to see how this all plays out.
To get started this hour, come and stay with us with BNP Paribas. David Seif scheduled to join us here in a bit with Nomura. There's a heritage at BNP Paribas of a very, not sober, but acute dampened GDP number, real GDP. There's never any effervescence. There's never any, hope and prayer. It's like, this is the number we're going to live with. What can you make? Forget about a number. Can you actually make a real GDP call forward 12 months now? Or is it just impossible?
We can and do. We have to. We're looking for the economy to grow at a healthy pace this year. We're looking for GDP growth in the mid to high 2% range in the United States.
Like 2.6, 2.7?
2.6 is what we're looking for. And we're looking for the first quarter to be even more optimistic. We're looking for the first quarter to come in at 3.7%. Of course, things don't feel good out there with this high oil price environment, but the U.S. economy has a lot of momentum behind it. And as well, while we're talking about the drag because of high oil prices, we have positives as well. We had some pretty significant tax changes in the OBBA, and those tax refunds, we think, are going to be a nice little tailwind to consumers as we start off the year. So we think the economy continues to remain resilient. If oil prices remain high for a long period of time, that's certainly going to question the optimism. But for now, we continue to remain quite optimistic on the U.S. economy.
Inflation, that's the other thing we got to worry about here with, again, oil over $100 a barrel. John Tucker's paying $1 more per gallon at the pump. What's your inflation outlook here?
We think inflation is going to be high. We're looking for inflation at above 3% this year. We've been above consensus on inflation for a long time. And because inflation is, again, high and above target for 5 years in a row now, that drove, in part, our out of consensus call for the Fed not to be cutting rates more in 2026.